Hello everyone and welcome to today's Investor video analysis. My name is Peter and I'll be your narrator throughout today's video. As you may have noticed, these have been a pretty busy week full of important macroeconomic events. Let's sum up some of the major events and talk about them. So let's dive in. For the sake of the video staying short, we will only talk about the central bank's decision. However, there were other major and very important economic data throughout the week, such as the US labor market and other indicators. But let's get back to the central banks. The Fed delivered its monetary policy update on Wednesday, and the Bank of England and the ECB delivered their decisions on Thursday. So let's talk about the Fed. Basically, the Fed increased interest rates by 25 basis points. This has been fully expected by investors, and the central bank acknowledged recent efforts in bringing inflation down. Jeremy Powell also stated that the disinflationary process has begun, meaning that inflation has been in a downtrend over the previous months. So if you look at inflation in September, previous year, 2022, you can see a clear downtrend in inflation. However, the year-over-year inflation rate is still very high. It's around 7%, and the central bank's target is at 2%. So the Fed still has work to do to bring inflation down to their goal. However, increasing rates to above 4% recently seems to be working as inflation has started to decelerate lower. The market still predicts that the central bank would raise rates by another 25 basis points at its next meeting in March. However, this is expected to be the last rate hike of this tightening cycle, meaning the Fed funds will probably peak or will probably end around 5%. This is called or this is referred by the markets as the terminal rate. What is more important is the fact that interest rate swaps appear to be pricing the probability of interest rate cuts in the second half of this year, and currently we are seeing indication that the Fed will cut by at least 20 basis points in the second half of the year. And this is in a sharp contradiction of what the central bank has been communicating recently, as the Fed has repeatedly said that they don't plan to cut rates so soon, and they especially this year. So basically the market is not believing in the Fed anymore, and the market thinks that the Fed will have to cut interest rates pretty soon because the economy is running over and there are signs of recession in the US. But the central bank still keeps saying that no, we don't think that we will cut rates anytime soon. So we will just see who gets this right, and if the market gets it right, then the Fed will have to pivot and cave in and start cutting rates in the second half of the year. Let's take a look at the chart, like basically what happened after the decision. So here we see the dollar index, currency index, and this is the initial reaction to the Fed's decision and the conference. And as you can see, the dollar index lost around 1%, so it was a pretty steep decline. And if we take a look at the daily chart, then we can see that the dollar index has been trending lower in a very nice downward channel. And as long as this channel holds and is intact, that means that the bearish trend will likely continue. We are seeing some strong support here near 101, and if the index declines below that, the further leg lower can occur, probably targeting this level around 98. Let's go back to the presentation. The other central bank was the Bank of England, and the Bank of England increased interest rates by 50 basis points, but it also signaled that inflation may have peaked. So it was a pretty similar decision and pretty similar language than what the Fed used a day before. The MPC, or the Monetary Policy Committee, voted 7-2 to increase interest rates by half a percentage point. As said, 2 members voted against this increase. The same members voted against the increase in December, so basically no change there. But the committee remains split, and it looks like even more members will start voting against increasing interest rates further. So it implies that the Bank of England might be also nearing its terminal rate. Furthermore, the bank indicated that more monetary policy tightening might be necessary if there were signs of more persistent pressures. So this really looks like a shift from the prior approach, as the central bank had previously stated that it would act aggressively if necessary, and further hikes in bank rate may be necessary. Basically, what the central bank is now saying that if inflation continues to be dropping in England, and if there is no more inflation pressures, or if inflation will not start going high again, going up again, then the Monetary Policy Committee will likely stop their interest rates hiking process. So a very similar decision and a very similar approach than what we saw a day earlier in the US. And let's take a look how the pound traded after the decision. If we go to a 30 minutes chart, then we can see that this dovish tilt was taken by the market kind of negatively, and sterling fell around 150 pips against the greenback, which was a 1% decline. But today sentiment has changed slightly, and we are seeing investors trying to buy the dip, because if we take a look at the daily chart, then we can see a clear uptrend here with higher highs and higher lows. So basically, as long as this is intact, then bulls should be in charge. However, there is a pretty solid resistance here around 1.25, and sterling must climb above it pretty soon in order to confirm the bullish trend. Otherwise, there is a risk of some frustration among the bullish camp, which could drag the pound back to its 200-day moving average, circa in the 120 territory. And the last central bank was the ECB. It also delivered a hike of 50 basis points, which was the fifth time in a row. However, it said that there will be another half point increase in March, and after this decision in March, they will evaluate the future path. This is once again a very similar language than what we've seen with the Fed and with the Bank of England, because back in December, the ECB kept telling us that there's going to be 3 more rate hikes in the near future. However, yesterday, on Thursday, everything changed again, and now they are telling us that we hiked yesterday and there is only 1 hike left in March, and then we will see. Basically, they shifted their approach to a meeting by meeting decision making process, so they didn't provide any forward guidance. That is usually seen as a kind of negative thing by the markets, because when there is no forward guidance, then you cannot really plan anything in your decision making if you are an investor or a company or a trader. So this is not as good as it could have been, but again, it's the central bank, it can do whatever it pleases. As previously said, in December, the language has been or was a bit or significantly more hawkish, because inflation was still too high, and the ECB predicted that inflation will continue to rise. However, yesterday it turned out to be once again a bit more dovish, because they are only forecasting 1 extra rate hike and then a possible pause in the tightening cycle, same as for the Fed and for the Bank of England. If we take a look at the euro dollar, the reaction was pretty similar to the pound showed earlier. This This strong momentum in the euro dollar was from the FOMC on Wednesday. Then we hit a strong resistance near 1.10, which is a psychological barrier, and many traders and investors took their profits here. A slight decline occurred here, bringing the euro dollar down one big figure to 109. However, today's sentiment seems to be improving and investors are buying the dip. Again, if we switch to the daily chart, there is a very clear uptrend here, indicated by higher highs and higher lows. And as long as this is the case, then we expect the euro dollar to continue higher, possibly toward this level here at 1.12, which used to be a strong support in December 2021. So thanks for watching. We hope you like this video, and if you want to see more content like this, don't forget to subscribe on YouTube or follow us on other social media networks such as Twitter or Facebook or Instagram. Have a nice Friday and good luck with trading. Bye bye.